For much of the modern investment era, capital markets were dominated by public markets. Companies raised equity on stock exchanges, governments and corporations issued publicly traded bonds, and investors built portfolios primarily from listed securities. That is now outdated. Over the past 2 decades, a vast amount of investment activity has taken place on private markets. Private equity, private credit, venture capital, infrastructure, and other unlisted assets now represent substantial components of institutional portfolios. What's more, retail investors are also gaining greater access to private assets. Private markets have moved decisively from the margins of finance towards its center. This profound change in global capital markets, and potentially a major opportunity. Yet, whenever an asset class becomes exceptionally fashionable and capital follows, investors should ask not only what returns it has generated in the past, but what risks they are accepting. Several factors explain institutional investors' growing enthusiasm for private assets. Primary among these is the prospect of enhanced returns. Investors have historically received what is known as an illiquidity premium for committing capital for long periods. Diversification is another attraction. Private assets are not necessarily correlated with listed equities and bonds. Institutions such as pension funds have long investment horizons. A pension fund with liabilities stretching decades into the future does not necessarily require every investment to be immediately tradable. This means that private markets can provide a natural match between long-duration assets and long-duration liabilities. Public markets valuations are both transparent and timely. A listed company's share price can change every second. Private assets are different. Because they may trade only occasionally, valuations are generally estimated periodically using financial models, comparable transactions, and professional judgment. Consequently, a privately owned company may appear considerably less volatile than a comparable listed company, with valuations typically being made quarterly. Where underlying economic volatility is understated, this can make private investments appear less risky than they actually are. Investors therefore need to distinguish between an asset whose price is stable and an asset whose price is simply observed infrequently. Liquidity presents an equally important challenge. Traditional private equity funds may lock up investors' capital for 10 years or longer. Infrastructure investments can have even longer horizons. But if and when investors require cash unexpectedly, or when distributions from existing investments slow, just as commitments to new funds require additional capital, lack of liquidity can be fatal, a factor particularly important for the growing cohort of retail investors. The fact of making an illiquid asset available through a fund offering periodic liquidity does not make the underlying asset liquid. The rapid expansion of private markets has inevitably attracted greater regulatory scrutiny. Particular concerns include leverage, valuation practices, transparency, conflicts of interest, and connections between private funds and the banking system. The IMF has noted the growing importance and interconnectedness of non-bank financial institutions engaged in private markets trading, which has the potential to amplify financial shocks. The impressive returns generated by private assets has led to suggestions of an investment bubble, but this is probably too simplistic. Private equity, private credit, infrastructure, and venture capital perform genuine economic functions. They finance businesses, innovation, and infrastructure while providing investors with opportunities unavailable through traditional public markets. For these reasons, their long-term expansion seems likely to continue. But higher returns generally only exist in private markets because investors accept additional risks: illiquidity, leverage, complexity, valuation, uncertainty, and greater dependence on manager skill. Furthermore, as more money enters private markets, excess returns may become harder to achieve. Too much capital pursuing too few attractive investments inevitably push acquisition prices higher and depress future returns. The implication of this is that manager selection will become increasingly important. By tracking a public market index, investors can cheaply obtain the market return. But performance dispersion between successful and unsuccessful private market managers can be substantial. The next stage in the development of private markets may therefore be less about whether investors should participate and more about where, how, and with whom they invest.